The best time to make money in a stock market, in real estate, is during a recession, because it's during this time where you see a lot of movement in prices. Overall, it's a very downward trend. There are some days you find in there that have really strong up days, but you find a lot of assets that are going to be steeply discounted at this moment of time in the short term. But in the long term, they should return to where they were pre-recession. And if the company's reliable, it should be able to get a little higher than where it was before everything went down. So in this video, I'm going to share some of the strategies you can use to better position yourself for after the recession so that you're able to enjoy that upswing. And it's very important to, one thing to just avoid doing right away is panic selling. A lot of people, they see the stock market go down and they feel like they just have to sell and protect themselves from losses. And while this is a good strategy when you are being intentional with what you're selling, panic selling is just blindly selling and not really having an idea of what your exit price would be, what your re-entry price would be. So having an idea of those types of numbers up front gives you a better idea of when to sell rather than just selling on emotion. So one of the common themes about recessions is that people spend less money. And you see that. You see, there's entertainment that's no longer open. People aren't traveling anymore, but people are still spending money. Corporations are still spending money. And to figure out where they're spending money on, all you have to do is look at what are the things that they absolutely need. So people, we still need food. That's why all these grocery stocks are doing pretty well. You look at corporations. I mean, they're going to keep paying for their buildings, a lot of them anyway. So those types of real estate companies that work with the major corporations that are able to pay off their buildings, those companies are still in a position to bring in the income they need to make. And if you're a company that, government spending makes up a good amount of your income, government spending isn't going to stop either. So you want to look first at what are the types of products, types of brands, types of sectors that people are still going to spend their money on. That's why a stock like Amazon's doing pretty well at the moment. It's rebounded quicker than some of the other options because people are still buying heavily on Amazon.com, and people are also still buying heavily at Whole Foods. So you have that element where it's not just the online side, where if you're able to buy things online and you have that e-commerce setup and that's what the company is, it's still in a position where people can buy versus a local restaurant that doesn't have a digital option. It's that type of setup where people can still buy. They're not buying, as much of like non-essential stuff, but the companies that offer that type of essential stuff, whether it's to the consumer or a corporation where it's like a building or a place to store documents, in that case, IRM would be a good example of a stock that could still do well in this type of environment. Or you're looking at a company that's getting heavily government spending, that's going to help determine which stocks are picks in this environment. Another thing to think about is the stocks that are going to get hit the hardest. So you're looking at travel, entertainment, places that, because of stay at home, you can't really, those aren't viable to people anymore. So those are going to get hit hard. If you are a shareholder in those companies, you can either, it's good to ideally look at the crystal ball and sell beforehand. But again, you don't want to panic sell. You want to have the idea of, do I see this going lower? Do I think this can rebound also? So like travel stocks, they're going to rebound when this is over. And it may take time for them to rebound because, you have corporations that they have less money, so they may go on less business trips and make those kinds of expenses. You have some people who may want to slowly get back into it. You may also have some people who, when this is over, they just want to get out and have that big vacation. So regardless of how quickly or more likely slowly the travel industry recovers, people still need their planes and the ability to fly from place to place. It's pretty essential in today's world. So those companies are going to go back and be better than they were before at some point. So you do at the same time you don't want to go into any company. You want to figure out which of these companies makes the most sense for your criteria. So a stock like Delta makes sense for me because they offer a dividend. It's a growing dividend. I know they recently suspended their dividend for the time being, but given its existing assets, Delta is likely to survive this type of an atmosphere. So you could approach this in a few ways. If you don't have any Delta, you could wait for it to go down more and plan on buying some then and there. If you already have a position in Delta, what you could do is DCA, where you buy the stock at a lower price right now than when you bought it at. So let's say you bought some at 40, you get some now at 20. I'm just making these numbers really easy from a pricing standpoint. I know as of this video, it's not a 20 yet, but you get the same amount of 40 and the same amount of 20. Your dollar cost average is now $30 per share. So people will buy a stock at a lower price point and continue to buy on the dips to have that lower average. So this is the idea of don't spend all of your money in one shot. Don't invest it all in one shot. Instead, spread it out in little increments so you're able to take advantage of all these different dips. Now, obviously, if you keep investing and it keeps dipping, that wall shows, that's going to hurt. So that's why you want to, when you put money in a stock or in an index fund, you want to have the idea of let's ride this out for like 2 years. You don't need the money for at least 2 years. In some cases, you just keep the money in forever, but you don't need the money for at least 2 years because that gives things enough time to gain momentum rather than being on the short-term loss and having to sell right then and there because you need the money. Now it's more important than ever to know where you stand as an investor, what your criteria looks like, so you can find the best deals that make sense for your portfolio and the goals that you're going after. Some people will look for the growth stock that's on a discount right now because growth isn't happening too much for that company at this time. Other people will look for the stock that's been giving a consistent dividend. Maybe that dividend got cut entirely, or maybe that company is still able to pay the dividend because it has good amounts of cash reserves. It had a relatively low payout ratio heading into the coronavirus. So know what makes the most sense for your portfolio based on types of goals. Do you just care about appreciation? Do you care about receiving a consistent dividend? So once you figure that out, you're able to better make right investments that help you grow your portfolio. If you do enjoy this channel and want more videos like this, make sure you subscribe for more content and hit the notification bell so you don't miss a single one. If you do enjoy this video, make sure you smash that like button, and I'd love to hear from you what you're doing right now with your investments during the recession. Signing off, dream big, achieve greatness, and unlock your potential today.